Hey everybody, welcome back to another episode of Unlocking Doors. My name is Cory Meals. I'm here with Michelle Castle and Sean Kincannon. Sean is a special guest today with Red River Title, so we're excited to have him.
Thank you.
And the reason we have him on the show today is because we're talking about escrow accounts. We're coming up on the end of the year, and a lot of buyers have questions on what is an escrow account, how does it work, why do I need it? So Sean, to start us off, can you answer just the simple question of what is an escrow account and when are they set up, and just kind of a little bit of background on why they're there?
Sure. Thanks for asking. So an escrow account, or escrow in nature, is where a neutral third party is holding funds for future disbursements. Much like a title company, it also serves as an escrow company. We take the money and we disperse it to the sellers and the lien holders and the agents and everyone else. So does a lender manage an escrow account for their borrowers. So an escrow account is where you make your monthly payments that include taxes and insurance at a minimum. That's put into a reserve account that's managed by a lender, right? And then when the taxes come due, out of that escrow account, they pay the taxes. When the insurance renews, they pay the insurance.
Very good.
Simply put, I guess.
Okay, yeah. Michelle, how many months of cushion does a lender collect for an escrow account? Because I've seen a couple different things, and just talk about why it's different for taxes versus insurance and how they're paid out and how they're collected.
Yeah, that gets a little more tricky because when you think about it, we're holding funds so that we can disperse funds. So the amount that we are collecting up front is going to be determined by when we're going to pay that bill again, right? So traditionally, when we are estimating what that escrow account is going to look like, we typically will collect 3 months of taxes and insurance. Now, if we have, if taxes more specifically, we've got to make sure that we have enough funds in the account to pay the tax bill for that property owner at the time the bill is dispersed, which might be a little bit different than what the tax bill would be for the seller who's departing the home. So the amount that we would collect could be more so that we have enough money in the account to pay the bill. There's also tax credits that the seller is given for the portion of the year that they own the home. So we're going to settle up that discrepancy and make sure that we can cover the bill when it's due and allow ourselves a little bit of a cushion in case the bill is more than what we expected it to be. If there's excess funds, then we'll reimburse those excess funds when we settle up that account. But we collect that cushion, which we typically say 3 to 4 months cushion, to make sure we have enough funds for that.
Okay.
So that's a complicated answer and not a set amount of months.
So Michelle said something interesting about only collecting 3 or 4 months to start up an escrow account. But when a buyer or a buyer's agent is looking at a settlement statement, and let's say, for instance, we're closing in August, they'll see 14 months of taxes on a settlement statement. And Michelle just said we only collect 3 months. That doesn't check, right? Well, no, she's correct. They only collected 3 months because later on in that same settlement statement, separately, a seller has given that prorated credit to the buyer for their portion of the taxes. So if we're closing in month 10 or 9, for instance, and she's collected 14 months of insurance, they still only paid 2 or 3 months up front into their initial escrow deposit because that seller gave them that 9 months as a prorated credit to offset that. So they still only paid the 2 or 3 months cushion up front, plus their monthly payments will finish that out after closing to collect the entire year. So she's exactly right. You only collect 2 or 3 months, but the seller still pays their fair portion of the year in the form of a credit to a buyer.
Another follow-up question I have to that is, and this is where some of my buyers get confused and even sellers, is understanding when taxes in Texas are paid and where those amounts, where that estimated tax amount comes from. Can you talk about that a little bit?
Across Texas, tax bills come due in October, but we're in Grayson County. And in my 20 years, taxes have come due in October maybe once. And this year, as of this filming, they're still not out, and we're almost to Thanksgiving. But to answer your question that you asked, taxes come due in the fall, usually in October. Grayson County is November, sometimes December. And so taxes are in arrears. You pay taxes at the end of the billable year that we're in. In other words, you pay 2024 taxes at the end of 2024. So the lender is catching up. That's why we mentioned that they're collecting 12 or 13 months of taxes as early as August and September, because we're in the 8th or 9th month at that point, and the 2 months cushion, and your first payment being put out 45 days from closing. So they're basically collecting a whole year as early as August, because by the time you start making your payments, taxes are due at the end of
But
the year.
technically, they're not past due until the end of January.
That's correct.
But most lenders will pay it the year before for federal tax benefit for the homeowner. So you can go ahead and write off your taxes for the year the taxes are paid for the taxes.
That's
rendered.
right. And every property owner needs to be diligent in reviewing their escrow account that they see with their lender, and you will see that disbursement. The lenders, especially Guild, will notate on their online statement when the taxes were paid. And you're exactly right. They're usually almost always paid by the end of December. Again, Grayson County is so far behind, but they're not past due until February 1st of the following year. So if you are someone that is self-escrowing, which is not what we're talking about here, that's when the late fees would start to apply. But most lenders do pay them by the end of the calendar year if possible. And you brought up another good point. That escrow analysis that they can get on their online banking, on your portal and your app that they have, taxes are deductible, right? I believe they are. And so you want to get that statement to show your CPA anyway. And so it's important to monitor your lender's management of your escrow account.
I want to talk about something that maybe doesn't come up very often, but if it does, it could be an issue for a buyer who may be getting two different tax bills. So that's something that, if the lender is only collecting one of those tax bills, and that would be a situation where maybe you buy this with somebody other than your spouse, you're buying a property with somebody other than a spouse, you're going to get two tax bills. If the lender only gets one of those, what happens in that situation, and how do you kind of rectify that when it comes to the escrow account?
It's a mess is the short answer, or it can be. The short answer is every property owner needs to be diligent in reviewing their tax bills, reviewing their lender's management of their escrow account. But just as you stated, if you have a multiple seller situation and one buyer, it could be the opposite. If you have one seller and multiple buyers, in either event, you've got to make sure that your taxes collectively are 100% being paid. So if you buy a house that has two tax bills at 50%, if Cory Meals and Colby Mills own a property together and I'm buying it, I've got to make sure the tax office has merged those two tax accounts into one, because in many cases they may keep both of those tax accounts, and I have one that's a 50% ownership and another one that's a 50% ownership. If Guild sends their notice to the tax office saying send us the tax bill, and they don't update both of them, then that second tax bill never makes it to Guild. They never know to not pay it, that there's a bill they didn't pay, and you're stuck with the late fees as the property owner. So the short answer is you have to be diligent to know if you're buying something with multiple tax accounts, or if your situation is that you might have multiple. So if you have a parent co-signing, and you're going to have two tax bills, you need to make sure both of those tax bills make it to your lender to pay your escrow account.
So, Sean, tell the listeners what they can look for on the tax bill to know that there are two bills.
So right under the billing info, so in other words, I own a property and it says the property owner info, the billing info, Sean, my mailing address, it should say right below that 50%. And it may only say 50%. It may not be more specific than that. Another telltale is look at the value. If you bought a $200,000 house and your tax bill says we valued it at $100,000, that's a 50%. They only valued half of it. So it may look nice because you think, oh, they really gave me a good value on this property. Well, most tax entities don't give us, that good of a deal. So you got to be diligent and look for that 50%. The main thing you can do is be in touch with your local appraisal district. It's a little intimidating to go in there. That's the place you go to argue values, to place your exemptions, but they're also there to help. They are a county office that's intended to help. Go there and get it explained to you if you have multiple accounts, why you have multiple accounts, and are they all being managed correctly?
Another misunderstanding, and you talked about a parent co-signing, is that homestead exemptions are even different because the homestead exemption is for the homeowner who's living in the property. You can file exemption. But if you have mom and dad who also own a property and they're not living in this house, the homestead exemption is only going to be applied to the 50% that you own of the house.
That's right.
And paying attention to that, I think, is really important too.
Or the couple that is engaged but not yet married, and they buy a house and get a loan together. This exact same situation. If you're not yet married, then both parties need to apply for their homestead exemption. Or if mom and dad are co-signing and they own another property in Texas, the buyer and you as a lender are preparing that tax account to only get a 50% exemption for your 50% ownership.
And that is another conversation in itself.
Yes.
And I see it often. If someone is working with let's just say a lender that is outside of this area and doesn't understand our homestead laws and how our taxes work, the escrow account could be set up incorrectly.
Oh, absolutely. It happens all the time.
It does happen all the time. And I don't see it at closing. You do. And by that time, it's too late. I see it when someone says, hey, another lender is able to offer me a better deal. And when you really look at the numbers, the better deal isn't really a better deal. It's just they don't understand our Texas laws and our taxes. And so it looks like a better deal, but it's going to catch up with you later whenever it comes time to do an escrow analysis.
Well, and I see that with other lenders when a seller may have an exemption that a buyer's not going to be eligible for, and they don't even know that those exemptions or credits apply. And so, they present to a lender, oh, the taxes are only $1,200 a year, so I'm going to quote you a better payment because of that, not knowing that the seller is actually over 65 and the buyer is not. You're preparing them for what the taxes will be,
right.
Whereas another online lender is promising them something that they can't actually fulfill.
Or even at the pre-qualification process, estimating what you need the taxes to be to help someone qualify for the house, knowing that that's not what the taxes are going to actually be.
That's right.
And it is going to catch up with you later.
Oh, it definitely will.
I would rather go ahead and figure it based on what it's going to be rather than them hit with a past due bill and an increase in mortgage payments later, which happens often.
Well, and even doing that before they buy the house. They need to be prepared to see, they get the big eyes and they think they can afford something, but that dose of reality is sometimes what a potential buyer needs.
As a real estate agent, though, the other thing that I see often is real estate agents not looking at how the property is taxed from a proration standpoint. So if you're representing a seller, and let's just say the seller is over 65 and they haven't had the tax bill's not what it's going to be for the buyer, the seller's responsibility is based on the taxes that they owe, not what the taxes would be if the buyer was buying and had owned the property the entire year. So the prorations and going ahead and making a buyer aware that they're going to owe a little bit more money because of the prorations are going to be different for the seller than what they would if they were paying that full tax bill. How do you pay attention to that?
Currently, I look at what the buyer is going to be paying for the property, and I kind of see if there's a discrepancy there, so I can say, hey, look, it's currently assessed here. Maybe the county hasn't adjusted this value in a while, and you're going to be paying well over that. So I just want to prepare you and your lender, I'll probably talk to the lender too, that you need to be prepared to pay, a little bit more each month in taxes. And it's one of those things where if you see, like like Sean said earlier, if you've got a $400,000 house and the taxes are $1,200 a year on it, that doesn't check out here in Texas. So it's one of those things where you just kind of have to look at all that stuff. You want to make sure that number one, if we're working with a local lender, they're looking at that stuff too, and they're setting our buyers up for success. But if it's an out-of-state lender or somebody who's maybe, you've got 10 different people touching that file and nobody's really paying too much attention to the details, that's where I just kind of bring it up to the buyer and make sure that they fully understand. And I've been in closings where Sean's brought that up. And, another thing that I see all the time is with new construction where it's currently assessed at the lot value and the lender may be out of state or whatever, and they're collecting taxes on an assessed value for a lot versus a completed new construction home that's going to be several $100,000 more. Sean's had that conversations with buyers. I've had that conversations with buyers just to make sure that they don't have a huge escrow account adjustment, the following year whenever they get their first tax bill. And then, another thing I wanted to talk about too is it's not just taxes either. Whenever we're talking about escrow accounts, insurance plays a big part of that now. It used to not be. We used to be able to know pretty well what your insurance payment was going to be. I could estimate that pretty quickly. Of course, I would always say consult an insurance professional, insurance agent. But now, insurance rates can be all over the place, and they can really affect buyers qualifying for a payment. So that's something that's pretty important to look out for as well.
I'm glad you brought insurance up because that was a conversation I was even having with someone this morning. Insurance renewals right now, the renewal premiums are coming in some cases, twice as much it was the year before. So when I'm looking at escrow accounts to really see where people are this time of the year, there's not enough money to pay their taxes because their insurance renewed earlier in the year and it used up all of the money set aside in their escrow account just to cover the insurance, and now taxes are due, which means there's going to be a shortage in that escrow account. And I know insurance agents aren't going to like to hear this, but before your insurance renews, which is really the 11th month after you purchase the home, ask your insurance agent what the renewal rate's going to be, what the premium's going to be, and it might be time to look at your coverage, see if there's any adjustments that can be made, anything that they can do to save you some money come renewal time. And if you have to, shop around, because that's the time to make those changes. You can make it in the middle of a premium cycle. If you wait till you get an escrow analysis in February and you shop around in March for a policy that renews in August, it's not like you can't shop around. It just makes it a little bit harder. And you're going to end up getting a renewal refund. You'll get a refund check from your insurance agent that a lot of people put in their pocket, and then they don't have any money in their escrow account for the following year. So paying attention, and don't hesitate to call your loan officer that did your loan in the first place and ask questions. What can I do in this situation? That's what we're here for.
Yeah, and one thing I want to add about shopping around for insurance and checking your coverage is make sure, and this doesn't really have anything to do with escrow accounts, but when you are shopping around and trying to save some money, don't underinsure yourself, because that's another thing that I see happen to homeowners is they get underinsured. They need to replace a roof. They have, they don't have the coverage to do it. And then usually at that point, we're trying to sell their house and they've got to come out of, either their equity or out of pocket to do whatever repair may be needed if a hailstorm or something came through. So yes, save money where you can, but don't underinsure yourself. So with that said, the last thing I really want to get into is talking about an escrow analysis. And when y'all do that, what does that look like, and why is it so important for homeowners to do?
So once a year, there are federal policies and rules put in place on escrow accounts. So we can't hold extra funds. So when you go to closing, we are going to collect more than what the actual costs are, so that we have funds in the account in case the cost for the following year are greater than what the costs were the previous. but we can't collect extra funds and keep it. We can't earn interest on those funds either. So once a year, we have to analyze the account, and we have to compare what we collected and what we paid out, and then refund any extra. Lately,
or raise their payment.
or raise their payment. Lately, there's not been extra because we've had increases in the cost of insurance and increase in the cost of property taxes. So what happens a lot of times is that the account is analyzed, and there's federal requirements on the notices that we send out, and sometimes they're really hard to understand. So under looking at that escrow account and seeing how the money is coming in and how the money is being paid out, we've talked about taxes and insurance, but the other escrowed amount is your mortgage insurance. So you're going to see money coming in, premiums paid out, bills paid out. And if there is any increases in any of those expenses, then we're going to figure what did we pay out in excess of what we collected, so that we can collect that back, reimburse ourselves. And we have to predict that in which the bills were the previous year is likely to continue the following year. So it'll look like we are double dipping whenever we increase the payment to cover the shortage, but that's because we're predicting what the payment's going to be in the future. So that's where you see the payment increases that people oftentimes are unprepared for. But it really shouldn't be a surprise, because when you get your insurance renewal, you should be paying attention to what did it cost me last year and what is the insurance cost this year, and know if we are paying more than what we collected. You have that heads up earlier in the year. Same thing with property taxes. When you get that tax bill in, you need to compare this year's tax bill to last year's tax bill and make sure that we have enough money in that account to pay it. And if we don't, go ahead and make adjustments in your budget to add to your monthly payment to go into your escrow account, or set the money aside into your savings account so you can write a check whenever it comes time to do that. But oftentimes that's not what happens.
So I would, and just to add to that, at least in Grayson County, but really across Texas, as you said, you can shop your renewals, you'll get your renewals early, but late April, early May, this appraisal district sends out property tax valuations. Many times, especially when you're escrowing, I hear this all the time, and I'm sure you do too, people don't even look at it. Not when they're 3 or 4 or 5, 10 years into the ownership of the property, they just kind of cast it aside. But it's important because that's your indicator. So if they've increased your value, if you've got your homestead, of course, they can't increase it more than 10%. But if you're not paying attention and they're doing that.
And I do want to clarify, they can't increase your tax liability more than 10%, but they can increase the tax valuation.
And do that homestead cap adjustment and all that stuff. That's right.
Just to clarify for our viewers.
But you have that indicator as early as May that your taxes are going to go up. And this is very easy to say, but hard to practice, which is if you know in May that you're going to be short, as you just said, you can start adding money. Lenders will accept escrow payments, in their payment. You can designate, I want to add an extra $100 to my escrow account so they can manage it, or you can self-manage it. Because when you're doing those escrow analysis, what I would tell you, and just using a round number as an example, if you have a $1,200 shortage total in your escrow account, your lender doesn't increase your payment $100. They increase it $200 because they need the $1,200 shortage from that prior year that was short. Plus, they say, like you mentioned, they want to account for the next year's $1,200 shortage. So they now increase your payment $200. But if you're prepared, because you've watched the value of your home, you've seen the renewal, and you knew what was going to happen by the time those disbursements were made, you can write that check for that shortage. Your payment only goes up $100, and you're not, over here struggling right after Christmas, paying credit card bills. Now I've got to have my mortgage payment go up too.
We're simplifying that a little bit because we still have the escrow reserve. So
Yes.
if you've depleted the account, you're going to have to pay the shortage, pay the future, plus the reserves again. But still, you understand the
Yeah.
calculations. And it
I have
really,
a
your
question on
escrow
reserves.
shortage should never be a surprise. It really shouldn't. If you're watching the evaluations that come out in the spring for your property taxes, you're paying attention to the tax bill that comes out in October, sometimes as late as November, December. Also, we're paying attention to your insurance renewals. Your escrow shortage should not be a surprise. It really shouldn't.
Well, I know you said that was the last question, but let me ask you a question, because I get buyers that ask me this. After you have had your loan for 2 or 3 years, can a borrower request the reserves be depleted, refunded, or do you have to keep reserves for the life of the loan?
It depends on the loan program. So if it's a government loan, USDA, VA, or FHA, you still have to have an escrow account. If you
Well, no,
were,
I'm talking about the cushion, the reserves.
oh no, it still has to be
It stays
there.
on there forever.
Yeah.
Okay.
But that brings up a good conversation. If you have a conventional loan and you've got enough equity to remove mortgage insurance, you typically can go ahead and request the removal of your escrow account as well, as long as your payments have been made on time. And I mean, there's some ands, ifs, or buts, but it's possible to remove your escrow account
Okay.
even after one's been set up on a mortgage.
Sean and Michelle, thank y'all so much for answering these questions. I know it brought a lot of clarity to a lot of viewers out there, homeowners that maybe don't understand their escrow account. And the main thing that I want to do is make sure that people that are watching this are prepared in their budgeting so that they don't get that, notice in January or February that they're short and they've got to make a huge adjustment in their monthly payment that they just weren't expecting. So, guys, if you have any questions about anything we talked about, or maybe you're looking at your escrow account and you're looking at your renewals and you're not sure what to expect or what it means, reach out to your loan officer, reach out to us. We would love to help you out. Thank y'all so much for checking out this episode of Unlocking Doors, and we will see you on the next one.